Welcome to Mastering Finance, the podcast, episode 5, where we'll be discussing how to raise capital for your business. My name is Nicholas Higgs.
And my name is Jarrell Hall.
And we have an excellent episode for you, and we have great guests to talk about it today. We have Robert Pantry, CEO and founder of Simplified Lending, as well as Liacarla Adderley, who's the Area Vice President for Business Banking for RBC for the Bahamas and Turks and Caicos. Thank you for coming today.
Thank you for having us.
Excellent. When it comes to the onboarding process, so someone has now pitch their idea to you, you've been through, well actually let's shift it. When it comes to borrowing, someone send their plan and they think it's a decision the next week. When you spoke about sensitivity analysis, some entrepreneurs have a sensitivity analysis in their plan, but you're doing your own. So they think you're supposed to go off yours. Can you just speak a little bit about the behind the scenes? There's a credit committees involved. There's, some banks have the lender, the loan officer is the relationship manager. Some institutions have it separated completely. What should an entrepreneur understand about the process when they say they're approaching someone from the debt side?
I think the first place to start is to understand that commercial lending and personal lending are two different things, right? So personal lending, in most cases, is pretty straightforward. Someone has a salary, you assess the salary that comes in, all of the expenses that person has, and then you have what we call net income available to service the debt. With businesses, it's obviously a lot more complex, right? Yes, you may have financial statements, and so we have to understand those financial statements. We have to validate some of the information that's on the financial statement. So for example, if you say you've made $1 million in revenues, right? Okay, show us how you made that. So we look at your account statements. Do we see that revenue going through the account? And then, of course, we talk about the sensitivity analysis. We do that as well. And then we also do market analysis, right? So whereas with a personal facility, there's no market analysis. The most market analysis you may do is, okay, what is the person's prospect of continued employment, right? Are you going to be employed in the next 2 to 3 years? We look at, okay, is this a viable business? Will this business be able to continue long term, right? And so we do that by looking at the market and analyzing the market. So there's so many more things that go into commercial lending and analysis. So it's not come up banking with this 24-hour turnaround time. Like I tell anyone coming in, I want to manage expectations, right? So there's this thing that we say, and it also depends on volumes and workload that any financial institution is dealing with at the time, right? But typically, commercial lending, once all of the information is in hand, could take weeks to turn around. Yeah, we're not talking about a week, 2, but definitely more than that.
We're talking months?
I would hope not. Yeah, I mean, because we do understand, listen, like, this is their dream that they need to get moving on, right? So, but I'd say we used to say 2 weeks, but lending has gotten even more complex. So I'd say the average would be around 4 weeks to be realistic.
So Robert, you seeing both sides of the coin.
Yeah.
What are your thoughts?
So I think for the entrepreneur, they have to understand that the lender is right next to you in the pecking order, right? And I'll explain, right? So a lender wants you to succeed, right? They do have a process to go through, right? They want to say yes, but they have to go through a process, and that process can involve, the sales officer or your relationship manager, then their boss, then the boss, then a committee, right? It could be a lot of process, but the reality is, and I've seen where some entrepreneurs got upset with the maybe the relationship officer because they said, well, you told me that you think this is doable, and they think that is a yes. That's not a yes, right? But they say it's doable because they want to be in partnership with you. And I'll tell you why your relationship manager is in partner with you. When you look on the pecking order, in terms of earning money, it's the entrepreneur. We at the bottom, right? The lender is just above, right? So you think about it. Your suppliers and vendors probably up front, right? Because you need to buy the supplies to make the money, right? And then, so you buy the supplies, so they get paid, they're fine, right? Then you have everything else. You have marketing, you got to market the product. In order to sell the product, you need staff. So everybody's getting paid, right? You got the government, right? And you got everybody getting paid. And that interest expense that the lenders make, right, comes way down, right? And the lender realized that, okay, I'm already in, so I need you to keep buying the products. I need you to keep paying the staff. I need you to pay the government in order to pay me my interest. So once the entrepreneur understands that that lender is your partner at the bottom, right? I can be very profitable if all those things go well, but they're your partner. And I think there has to be a level of trust, understanding that any credit process or any process of raising funds is not going to be easy. It's not going to be, to Liacarla point, you not just come and sign and go, right? It's going to be a process, right? Due diligence, and that part of that due diligence is to also protect you, the entrepreneur, so that you don't, right? So the due diligence is part of it. So as long as the entrepreneur see the lenders as partner, it's going to be easier to navigate than the full process. You know, you say, okay, listen, I know, you know, the credit committee say, okay, you know, we can't do that, but we can do this. Okay, let's adjust. Let me look at my business plan. Let's tweak some stuff here. Let's move some stuff around. You know, okay, good. You know, and you do it together.
Yeah, I think it's a good point you raised about the credit committee, right? Because I always hear these stories, especially from, you know, clients who've been in business for a number of years. They talk about these stories where they used to go into the bank, you know, sit up at the branch manager, and they have a need, and, you know, they'll have a check written the following day. Those days are gone. I tell all my clients, those days are gone, okay? I believe most financial institutions have, whether you call it a credit committee, credit risk, but some separate independent team that actually assesses what you're proposing, and then they provide what we call the adjudication or the approval on that, right? So I think, you know, younger entrepreneurs coming up, they're familiar with that, but you know, you have those ones that they hold on to that history and those memories, right?
I think the younger generation, they still have that to some extent, but it ain't the bank anymore when cut the check. That's mommy and daddy and Grammy. Okay. I need some money to start my business. Okay, here. Right?
There's a level of entitlement that exists. I didn't appreciate the credit committee concept until I had to create my own. And then you're putting in the standards. You're like, I can't give you this money. This don't add up. This don't add up. And so you appreciate the level of responsibility you have, where if I say yes to this, my persons I report to are looking at me and judging me for the decisions I've made. Yeah. So I want, like you said, I want to give you the money. Yeah. I believe in this idea. But this 2-3 points right here just ain't adding up.
Can't fly.
It isn't adding up.
Yeah, that person, that relationship manager has some targets to meet. So they really want to give you this money.
Yeah. And so for the entrepreneurs listening, you have the relationship managers, you have loan officers, you have the credit risk department, you have the credit risk review department, and then you have to go to the legal side after. With some entities, you got to go to the board for approvals, and then you have the legal side that handles it. And even when you're looking at an equity investment, it may not have that much layers, but those investors, they represent those much layers. They're in 2 or 3, how many persons you're getting equity from, and they're asking you these hard questions, and they're thinking these exact same things because they don't have a whole separate department. It is them and their money, and they have to protect it. So it's a process, and you have to appreciate that process. And whenever that investor says yes, that means they are going with you on this journey.
Yeah. I think the points make sense. Like, I have a personal experience where I had to raise some money for a business, actually one that I'm working on right now. But that process took me about 3 months, right, from initial pitch, right, then due diligence on behalf of the potential investor, questions you have to go back and answer. And quite frankly, that I appreciate that process because at certain points it helped me to really think through the business even more. And then eventually getting to the point of funding. And in that instance, it was a private investor, right? So like Nick said, him and his money. Right. So very honest and hard conversations, right? Asking you what's your level of commitment, what's your skin in the game, you mentioned that earlier, right? And being able to really like show exactly what this business can potentially bring in terms of value to them. But I think one of the questions I wanted to ask, like we touched on it briefly, is around personal savings, right? And there's an interesting statistic, I think it's from the Small Business Administration in the US, which talks about 75% of small businesses start the initial capital raise with their personal savings, and then there's about 10% that does their, sort of the traditional routes of funding. Do you guys find that to be a statistic that's sort of relevant to our jurisdiction in terms of the persons who you guys fund? And I guess another way to ask that is, of the total persons that come to you for funding, and obviously as much as you can reveal, like what's that percentage that you think fall into that 10% category for funding?
I actually think in most cases, I mean, sometimes by the time the entrepreneur comes to us, their balance sheet may look different, right? But I think at the core of it is that most entrepreneurs that are successful in obtaining traditional lending would have started with their personal savings, right? And even if they didn't start with their personal savings, they would have built up equity in the business, whether it's by reinvesting the earnings of the business or just keeping it, in cash or something else. But and that's very important, right? I think that's one of the pitfalls that we see quite often locally, is where entrepreneurs are successful in the early days and they don't reinvest in the business. So I always preach, pay yourself a salary and stick to it. And in the first couple of years, if you can, don't even talk about dividends. Don't even talk about drawings, right? Reinvest every dollar so you build up that capital base. Because when you come to the bank and ask for financing, one of the things we look at is shareholders' equity. If that doesn't exist, it's going to be very difficult for us to consider giving you funding. So you build up that shareholders' equity by every year. When you make that extra $10,000, put it back in the business. It could be buy more inventory, buy equipment, or just put it on, just leave it on cash, but reinvest it as opposed to taking it out, going on vacation or doing something, because you're building your equity, and that's very important, right? And so I would say those persons that start with their personal savings tend to be more successful in obtaining financing. Hands down.
I think to just add to the point, because I would be interested in that stat in the States, 75%. I think that may be based on maybe dollar value compared to number of funding, because in the States, you can get, venture fund much easier here, there than in the Bahamas. So I would say definitely, I think very few startups or start out with any type of external funding, third-party funding. I would say at least about 95 start with their own funding, and funding from borrowing from mommy, daddy, brother, sister, Grammy, uncle. Those traditionally in the Bahamas and the Caribbean. I think it's getting better, but I think it's important for the process. But where the trend, what I'm seeing, because deposit rates are so low in the country, I'm seeing a lot of individuals willing to help out their cousin, their brother, their sister, their friend, and go and fund with some early seed equity. But the vast majority comes from the entrepreneur, not just only in cash in terms of savings, in terms of their time, their effort, their energy, right? Them doing multiple jobs. That is, that is part of it. And to Liacarla's point, you got to pay yourself a salary. But I would switch that a bit. Don't pay yourself a salary. Pay yourself a commission, right? Pay yourself a commission, and however you choose it. And, sales coming, I can pay myself X upon of sales for selling something or driving business growth. I think that is going to allow for a bit more innovation. It allows for a bit more patience, and even when you're tired in the morning, because you're trying to close that commission, you're going to get up. Even when you're tired, you're going to get and you're going to make it happen. So definitely don't pull money out the business. Just when you make money, you spend money.
After someone is funded, the accountability and responsibility that the entrepreneur must maintain. So financial statements, you can't just take the money and disappear.
So, after an entrepreneur's been funded, what are some of the obligations after that the entrepreneur should think about?
So
I'll
you probably
start.
take it.
So, yeah, I mean, it's not a case of, someone just gives you money and that's it, right? They don't look back, they just expect you to pay them. Yeah, obviously the first thing would be making sure that, you stick to your repayment schedule. But typically what you'll find with commercial lending, you'll see something that we call covenants or reporting requirements. So the standard one, of course, is financial statements, right? So if you're getting a business loan, whether it's a traditional lending institution or an investor who may have equity in the business, everyone's going to ask you for financial statements to be produced at least annually. In some cases, we may ask you for it more frequently, quarterly, biannually, but definitely on a consistent basis. They want some sort of independent report to understand what's happening with the business, right? Of course, if collateral is involved, if a house is involved, we're going to want to see, confirmation of the insurance being paid, your real property taxes. So there are a number of things. On the covenant side, typically what you'll see is something called the debt service ratio. And that says that when we look at your net income should be sufficient to cover any debts that you have by a certain percentage. So the standard covenant that you tend to see is 1.25, right? And that gives you a cushion. We always want to see a cushion. And so we determine that 1.25 by seeing your financial statement. So we calculate it based on that. So it's all tied in. But I will say that those covenants, and more so the reporting requirements, those financial statements, tend to be a challenge, right? It really is in a lot of cases a case of, I'm happy I got the money, hey, I'm paying you back on time. So yeah, I can get you those financial statements when I get to it. But it's so important because there's going to be a time when you come back again, right? And that's going to actually hurt you because that speaks to your track record as well, not just repayment, but hey, have you honored the agreements and the covenants and the reporting requirements that we both agreed on? Because those are outlined in an offer letter that you sign and we sign, right? And so it's an agreement, and that speaks also to character. So any entrepreneurs listening out there, I encourage you, please read those reporting requirements that are stated in your letter and adhere to them.
So to piggyback off of Liacarla, I think she covered it excellent with the from the post funding, some of the things that happens afterwards. From an angel investor standpoint, a non-traditional lender standpoint, one of the things that comes afterwards is now you would have to be accountable to the board, right? The board will be established, and every quarter, right? So Liacarla speak to like traditional banks, they may say, okay, we once every year send in your financials, but every quarter, when you bring in an investor equity or even an alternative lender, they're going to want us to monitor the performance of the company, not just the financials, the operation, HR, strategy, IT, okay? So that understand that is a part of it. And it's not meant to be intrusive, but it's meant for people to understand how their investment is performing and if there's any mitigation they need to put into place. For the entrepreneur, they have to understand is that it's there to help them. Some entrepreneurs will take it as, you telling me how to run my business. Right. It's not that. It's not that you're telling you how to run your business. It's trying to help. We're in partnership together. I don't know really give you the funds, so we're in partnership together. I want to see this through to success, and so that part of it. Again, a lot of people don't see that part, but that's a part of it where there's more accountability. So when you take someone's money, know that there's more accountability, right? That just comes with the territory. So I'll always caution people again: don't be too quick to take the money, because understand there's great responsibility on the other side.
Yep.
Yeah.
So for the entrepreneurs listening, this is not to make you run away from investments or investors, but this is for you to appreciate what goes into the pre-funding stage, the funding stage, and the post-funding stage when you're looking for financing, whether it's on the equity side, whether it's on the debt side, or whether there's a blend of the two. And so related to family islands, Bahamas, 700 islands and keys, a lot of different cultures, personality types, business structures on it. So Robert, for you specifically, when it comes to your lending institution, you've been the entrepreneur and you've been the person in the commercial entity. How do we address entrepreneurs looking for funding on the family islands? Is it possible? How should an entrepreneur approach lenders or investors?
Well, let's go back to what we started out in terms of market research, right? An entrepreneur got to answer a key question, right? In terms of the type of funding and the dollar amount of funding you need, right? You have to look at it in terms of, can this business scale? That's one, okay? Okay, if it can scale, then you may need a big amount. Or is this something I just love doing as a pastime, right? So the dollar amount may be different, right? And maybe, if you only want to keep it small family island, small, then maybe the type of funding probably not, it limits, you may want to limit it. But you have to really take a deep dive and say, what do I want for my business, right? Because once they understand that, right, you'll be able to access funding, right? Because most people think that, oh, I'm in the family island, I need to keep it small. You don't need to keep it small, right? With technology, with the internet, with everything else, right? You can scale your business from the family island. Okay, if it's services, what service can I sell, right? If it's manufacturing, you can manufacture on a family island, right? Put on the mail boat, sell it in Nassau, ship it to the States. You can get a global audience, right? So you can shrink the world. So don't just think I'm in a family island, I have to think small. Think big, but you have to answer some truthful questions, because when you're looking to scale your business, even though you made a family island, you may have to be working around the clock. So that family island lifestyle of a slower pace, and it may be fast paced, right? So I think it really boils down to the entrepreneur. Like, what do I want, right? Do I want the family island life where it's a slower pace, not too much growth? And then that's fine, right? And that's a different type of funding source that you may want to tap into. That sounds a little bit more like family and friends, right? But if you're looking for more traditional lenders, okay, you need to determine, okay, do I really want to scale this business, right? It's going to impact your family island life and the way of life, right? But what do you want as that entrepreneur? But I think the family island presents a wonderful opportunity for people, but you got to think outside the box in the family island. Don't let us from Nassau box you in, and family island is, no. Be innovative, think outside the box, and look how you can leverage technology to achieve your goals.
Excellent point. Family island is not easy. It's not easy, and so family islanders, for the ones tuning in, and I mean for some of our global audience, they may not understand the concept of the family island, but in the Bahamas, you have the two main cities, New Providence, Nassau, and you have Grand Bahama via Freeport. Well, Freeport via Grand Bahama. And the family islands are considered those not within those two. And so you have magnificent islands, and so do not be discouraged. Unfortunately, it is more difficult. There are, unfortunately, less channels at times, but it's still possible. And so don't give up and keep pushing through to ensure you get the money that you need. Because there's a lot of successful business on the family islands. A lot of persons who don't do any hustle and bustle of the Nassau life, and they sitting there enjoying themselves, working very hard, the construction field doing magnificent, in places like Harbor Island and those. So you really could see a great return by investing on the equity side into entrepreneurs on the family islands.
Yeah, no, definitely. And I think, and to Robert's point about the types of businesses, like we talked about manufacturing, for example, you have, there's a company just out of Grand Bahama that's going to be manufacturing pipes, right? And so you take advantage of those opportunities there, the concessions that are available in the family islands. And to your point about thinking big, I mean, we live in a global society now that's digitally connected, right? So, what businesses can be started, in a particular location, but again, it's digitally based, right? You have things where you have, for example, if you're like a SaaS company, right? you have a talent that may be in India, for example, right? But your home base is in the Bahamas, right? If you're talking about a boutique hotel, then you have the ability to digitally connect to potential customers in the UK, in Asia, etc. And again, there are concessions that go along with that sort of business. Like I'm in hospitality, right? So I know for a fact that there are opportunities in the family islands. It's just about how you structure the model, right? Yeah.
Agreed.
So when we talk about use of proceeds, it's a very important component for an entrepreneur to consider. And you guys, Jesus Christ. I guess I'm so used to saying that. But. So use of proceeds is very important. And an entrepreneur should definitely think about that. Do you get...
Boy, you're going through it.
It's been a long day.
Just for the sponsors.
Yeah.
So use of proceeds is very important.
Right.
Is there a particular mix that you look for when considering use of proceeds? Should it be certain categories that it's allocated towards? Like, what do you look for when you consider how they're going to be allocating capital?
I mean, generally, we want the use of proceeds, or what is being used for is obviously to generate revenues. Some banks, especially the international ones, do have some restrictions. So, for example, gambling continues to be one, tobacco may be one. But other than that, if it's obviously would be a legitimate business and a legitimate venture, we're pretty flexible in terms of the use of proceeds.
Yeah, I think I would agree with Liacarla. It's really looking at the business and the business opportunity, and the probability of being paid back. I think that goes into it more. Yeah. So, but I would do tell you some of the riskier businesses, right? And this is for entrepreneurs as well, right? Restaurants.
Oh boy.
Very risky, right?
Very low margins.
And I know a lot of my friends, Robert, like, I want to open a business. And I was like, okay, that's fine, but do your research. That's all I ask. Just do your research, right? But restaurants is just, like you said, it's low margins. But one of the key challenges with restaurants is the turnover ratio. Your staff, every restaurant average about a 300% turnover staff every year, right? Every year, right? And so that poses by itself, right? It's very capital intensive, and then buyers' preference tend to change, right? And when a new restaurant comes open, everyone, right? And there's a tendency to be, once you say, well, wow, business is booming, I gotta invest, then I gotta go borrow money. I was like, just be patient. Let's, in terms of restaurant, proof of concept may take a bit longer, right? So can you withstand change in preference, etc., the turnover stuff? So restaurants is one of those business. I always caution people not to be too quick to take on debt. And a lot of lenders, from experience and in terms of the failure rate of restaurants, are very, very cautious with restaurants. Another one that's nightclubs,
I've never even seen a nightclub before. Have you seen one?
Yeah.
Have you seen nightclubs?
It's nightclubs, because again, there's so much that can go wrong with a nightclub. You could have one fight and it's, right?
One bar, yeah, man.
Exactly.
And
And
another better place come out, everyone just, the new craze anymore,
correct. And then you go only up in the night, and then, people go on the weekends. What about, you have to pay rent from Monday to Thursday, right?
So in that case, with the restaurants, because I'm pretty familiar with them, but with restaurants, in terms of use of proceeds, I guess what you're saying is that in that particular instance, having a relatively significant number towards training and maybe retention, would that be something that would say, okay, this is sort of one of the pitfalls that restaurants historically encounter, but we understand that, so we've done the research, we understand that that's a weakness, and so we're going to use these proceeds to then sort of reinforce the fact that, hey, this is what we understand to be a problem.
That's actually an excellent point, because one of the things when the big boom happened and then the slide with restaurant, the first thing they do, they want to cut back on staff wages. You know, they understand that a lot of staff are being paid on tips, and if the clientele isn't there, these people, they want to be able to live. So sometimes, you know, they wouldn't make the decision to, hey, just give these staff a salary or a higher salary. So that's a really excellent point, right? Investing in talent and making sure that your cash flow, because that is a key component in terms of restaurant success. We don't see it because we say, okay, if they leave, we can just hire someone else, and then we can hire someone else.
And the reason why I brought that up is, remember we spoke to Ethan Moss, we had on the podcast, and his approach to business, and he's in the service, he's in the petroleum business, but his approach was like completely different.
Yep.
His approach was, yes, we sell gas, right? We have convenience stores, but we tend to focus our attention on the people part of the business, and the service is just a byproduct of very good training. And so that's why I brought that up, because it was a very interesting perspective. When you brought up restaurants, I kind of, thought about it. I mean, Nick, I don't know what you...
No, I completely agree with you. Is it something we accept as just a nature of that business, or is that something that can actually be repaired? I know we're not talking about funding necessarily, we're talking about business development, but for a space like that, heavy service-based, heavy turnover, is it just the nature of those businesses? And how do you as a funder account for that?
I think...
And that's a part of it, right? What the business owner can do in terms of addressing those issues. There's something, in my opinion, that is not as much in their control, and that's what Robert talked about, consumer preferences, right? Everyone being gung-ho and all excited about this new restaurant, but after a while it dies down and they start to look at all of the other options that are available. So that is going to be a little bit more challenging to continue to address, and that's why restaurants are typically considered a little bit riskier, because there's some things that you just can't control, right? If I don't feel like eating there tonight, you could have the best servers, right? But that's not my choice tonight.
So I think, to your answer, yes, it can be changed. When you think about some of the pitfalls with restaurant they don't put enough of training and development into the employees. But it's not only restaurant, I think that's across the board. A lot of business. We bring a staff in, we train them for a week or 2 weeks, and then we put them in front of our customers, right? Training should be ongoing, every week, every day, constantly, right? To Liacarla's point, client's preference change. Okay, so the business needs to constantly evolve. The other component, what I find that how we can change that with restaurants, a lot of restaurants don't put systems in place, right? Even, let's say your chef, you get a high turnover of your chef, right? Well, why not put a system in place? You document it. When you're training your staff, okay, we use this amount of ketchup, this amount of salt, this amount of... So you systemize your operations such that even if it turnover, your system, and you train people to system. How do we deliver customer service, right? And then you say, Robert, wow, that sounds just like McDonald's. Yes, that's why McDonald's is still around. That's why the Wendy's. They systemize those things. They were initially just, okay, we just doing some burgers that rely on someone who know how to cook a burger really well. So I think that's one of the benefits that restaurants can do. We don't sit down and document our process and procedures enough, right? And so that's why we're susceptible to turnover, or high turnover. And that's why we actually get turnover, because sometimes, people come in and they say, hey, this chaos.
Succession planning is very important. Most small businesses, and especially startups, don't even consider succession planning. And so you're not even looking to say, I need to put these processes in place. And so to your original question, but you proceed, so to add in there from a lending perspective, lenders don't fund every aspect of your plan depending on what it is. Working capital, they're usually not funding the working capital. You have to use equity, grants, or your own funds directly into it for those. So you won't usually touch marketing. Sometimes inventory, some lenders won't touch, or they'll do it as a separate type of funding facility. Sometimes it's like a rolling facility. And so what should an entrepreneur know from that perspective when it comes to I need $1 million or I need $100,000? What are you not going to touch? So salaries. Sometimes we won't touch at all salaries. And so some clients have had a year worth of salaries, 6 months worth of salaries. And I'm like, the fund is not going to touch 1 day of salaries. So when it comes to that, they're putting together their plan, they have it together. Now they're at the funding section and they want to break it down. What area should they focus on when they're looking for debt? I know equity has a different structure, but for the debt side, what would you say?
Yeah, I mean, the reality is if you're coming to an institution saying you need assistance with funding to cover your expenses for the first 12 months, right? That's a red flag because we want to fund profitable businesses. And so if that's our starting point, I don't think the conversation is going to go well. Typically, yes, financial institutions won't fund working capital for startups in particular, but there are instances. So for example, let's say you have an established business, they have a book of receivables that they're having some challenge collecting right now, but you look at their receivables listing, it's aged properly in terms of not being too long overdue, not over the 90 days mark. And so, sometimes we will consider providing a cushion while they wait on collecting those receivables to provide them some cash flow relief. So it is, but again, it's for those businesses that have established that track record that we talked about.
On the equity side, sure, it's very different.
It's different. We understand that, you'll be funding salaries, marketing and stuff like that, right? But again, like I said, equity is your most expensive form of debt. No, you don't have to pay it back. No, you don't have an interest rate, but you give a part of your company, right? So, just understand that. But in terms of the alternative lending space, it's not a precise ratio. It's really based on the deal. Some deal may have strong collateral, so you may be able to get it done as an asset-based lending, and you can, fund whatever aspect of the business. But to Liacarla's point, generally speaking, if you see an entrepreneur, they present you a business plan, and when you dissect the business plan, most of it is going towards, soft costs, not really running off. It's a high percentage there. It's definitely a red flag. And then also in terms of skin in the game, if the entrepreneur, their salary makes up a big component of the salary, it's like, it's okay, this is a red flag. This person really don't want to be an entrepreneur. This person just want to be an employee, and you fund that, right? So it's a lot of different. It's not a one size fit all. It's every deal is different, to be honest with you.
And so I know we're coming to the end. So the last section we're going to do is questions we get from our audience, and 2, just some rapid fire questions, information that entrepreneurs would want to know. And so things just they could plug in. So let's say a client's putting a business plan together right now. What sort of interest rate? They don't know what the FIs are going to say. The financial institutions will say, what rate should they put in just as a plug-in number? Right? What would you recommend? A range? Just give a range. What should they put in?
We always lead with any rate quoted is indicative, right? But we know, so for example, on the personal side, average interest rates are somewhere around 4 to 5%. Commercial lending is typically higher. So I would say anywhere 6% and above is a good range to start with, if you just want to use that as an indicative rate, of course, for your projections.
Appreciate that, Robert.
And then, so in the alternative space, there's obviously they take on a higher risk.
Right.
So in the alternative space, if you're looking at an investment bank or an alternative lender, you're going to probably be looking at any range from 8% to 12, 13%. In the alternative space, because they can give you an alternative structure. Right. So that's the range you will probably be looking at. I know one of the things a lot of times investors look at, if they can buy, government bonds, which is risk-free. They put their money there, no hassle, no adjudication, or nothing. And if government bond paying, let's say 5%, right? So if I'm going to put my money someplace, probably it's not going to be at 5%. So sometimes we see business plans, hey, I want an alternative lender, and they present you at 5%, right? And so you would just probably compliment that person, but you're not going to have a serious conversation in the alternative loans.
Listen up. Risk-based lending is very important.
Yeah.
So you have to understand there's a base. The base is my risk-free rate. I can invest in government bonds without a worry.
Yeah.
I get my payment, it's not a question at all. And so you cannot approach me with the same rate because you have risk.
Yeah.
And so the more risk you have, the higher the rate's going to be. And so you have to be, that is very important for you to generally understand. Tenure. Tenure of a loan. Someone had to put it in, it depends on each business structure, but 20 year, are we giving a 20-year loans for businesses?
So, for at the higher rate, it's not intended to be a long-term thing,
Yeah.
right? So, an investor, with the higher rates, we want it no more than 12 months. So the actual money out of someone's pocket is lowest. 12 months, 24 months. It's almost a bridging facility for when you can, maybe get to a bank who's going to give you that lower rate. So, you work together. So that because again, with the higher rates, it's higher risk. Mm-hmm. The longer that money is out, the risk is even higher. So most of the times in the alternative space or the investment banking space, you want that capital, 24 months, 36 months probably max, and you're out.
Any questions?
No, go ahead.
Next one, partnerships. Me and my friends want to come together and put a business plan. We put a business plan together. We want to incorporate a company and get a business loan. How do you look at us from that perspective? Are you picking one person and saying you are the staple, you make the most cash in your full time? How do you look at it from that perspective?
You look at both, right? I mean, you both have, hopefully, skin in the game. And typically what we would ask for is what we call guarantees, personal guarantees. So both of you coming to the table, and so both of you are going to back that business. If there's a partnership and one of the partners they're not prepared to offer a guarantee, it's a red flag for us as well, because this is your business, so you should be able to stand behind it and say, here, stand behind it with my guarantee, right? Partnerships can become a little bit more complex because fighting can occur, right? And if you get to that stage, complications happen, and but we have no issues with partnerships. We look at them, but look at both shareholders.
Commonage land. Do we hold commonage land? So that's a very common thing. Hey, I have this land, 2 acres. Y'all ain't got to worry about that. That's y'all could hold it for about, and then it's a commonage land. So it's not theirs. Clear title to all the listeners.
Well, just going back to the question about term, right? So for traditional lending, a good ballpark would be equipment, typically 5 to 7 years. Real estate, we look at 10 to 15 years. To your point, sometimes 20 years, if we really push the envelope. But that's your standard guide in terms of how we term out facilities based on the purpose.
So any other advice you would give to entrepreneurs, things that they should look out for, things they should not do? I know this is a heavy episode, very a lot of information. Is there anything that quickly the listeners should know?
2 nuggets: keep proper records, keep your financial statements, and don't go into the till.
Right. Yeah.
Very, very heavy nuggets.
Well, I would go back to the partnership question. A lot of times I see, again, partnership is a great thing. How about others in the business? It's so much benefits, right? But for those in the business, we need to define who is in the business, right? So if me and you in partnership, we have to agree that me and you in partnership. I'm not in partnership with your wife, your cousin, your uncle, who all of our advice, right? Because we see a lot of business partnership fail, right? Even, sometimes we panic because when we issue a term sheet, like, okay, great. They came in together initially through this process. Everything was smooth, everything together, we'll be together. The minute we issue a term sheet and realize money is coming, then the next meeting, only 2 of the 3 showed up. Well, what happened? Oh, there were some issues with that person because the infighting started, right? In business, you always have to give up your rights for peace. You cannot let infighting and people start to say, okay, well, you only did this. Well, how come you do all of this and they only do that, right? So you have to keep boardroom business in the boardroom. Bedroom business, keep in the bedroom. Don't confuse the two, right? And you gotta again, it's never gonna be all equal. Even different parts of the business. Early on, you may need the person who's good at construction, so he can put up a bit more. Then later on down, you may need the accountant who can then do some more. Later on down, you may need the person who's more technical. He may do some. So it's different parts of the cycle. You can't start counting, right? So keeping a good relationship is very difficult, especially when a business is about to take off or is taking off or has taken off. That's when a lot of infighting come in, and that brings down a lot of businesses.
Completely agree. Completely agree. Jarrell, anything you had to close us out?
No, I mean, the partnership question kind of hits home, right? Because I've had experience with that, so I definitely understand. And I think a part of that to me is just about setting clear expectations, right, from the very onset. Because again, like it's kind of commonplace, but people say row day will come, right? And so it's about how do you handle that, and then understanding the ramifications of that, like as it pertains to funding, right? So I just wanted to make that point.
So for the listeners, a lot of information. Please absorb it. The only tip I would have is when it comes to buying other person's businesses, just because it's doing well for them, when you buy it, that doesn't mean it will automatically do well for you. Sometimes people go to businesses because of the owner, and now the owner is no longer there.
Exactly.
I can say from a personal experience, I invested money into a business. I borrowed this money. I say from my father, I borrowed this. I was very young. This is going to do well. I looked at the financial statements. The historicals look good. Projections were good. And as soon as we bought that business, we crumbled in 3 to 4 months. Yeah. Everyone said, hey, we like working with the business, but we're going to take a break. We've been doing this for 20 years. Yeah. And so literally that owner kept that business together.
Yeah, I had a similar experience too.
So you have to understand what you're buying. Sometimes they're tangibles and sometimes they're intangibles. And if you don't factor in both, you end up in a hard position. And so getting funding is a difficult process. It is achievable. And please take the time, take the effort, listen to the information, do your research, and you'll do well. So thank you for tuning in to another episode of Mastering Finance, the podcast. We thank our guests for coming and taking the time to discuss with us. And we look forward to doing many more. And tune in for the next episode of Mastering Finance. Thank you.